Preparing for a financial analyst at Telia interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What do you know about Telia and its business model? I would describe Telia as a telecom operator whose performance depends on connectivity revenue, customer retention, network investment, and disciplined capital allocation. A financial analyst should connect income statement results with operating drivers such as mobile service revenue, broadband ARPU, churn, device sales, and EBITDA. I would also consider cash conversion, spectrum and CapEx needs, leverage, and regulatory or competitive pressure when assessing sustainable earnings and supporting management decisions. While answering, focus on Telia's telecom operations, mobile and fixed connectivity, Nordic and Baltic footprint, recurring customer revenue, network investment, competition, regulation, and the analyst's role in linking operating performance to financial outcomes. Question 2. How would you analyze Telia's revenue performance? I would begin by separating revenue into mobile, broadband, enterprise, equipment, and other categories, then bridge the change from the prior period. For consumer services, I would examine subscribers, gross adds, churn, ARPU, pricing, and mix. I would distinguish organic growth from acquisitions, disposals, and currency translation. Finally, I would compare actual performance with budget and guidance, investigate the largest variances, and assess whether growth is recurring or promotion-driven. Make sure to cover revenue segmentation, volume and price effects, ARPU, subscriber additions, churn, product mix, country performance, foreign exchange, reported versus organic growth, and comparison with budget, prior year, and market expectations. Question 3. Which KPIs would you monitor for a telecom company like Telia? My core dashboard would include service revenue growth, mobile and broadband subscribers, ARPU, churn, net adds, EBITDA margin, CapEx intensity, operating cash flow, and free cash flow. I would also track customer acquisition cost, retention, network availability, data usage, and customer satisfaction. The important point is linking leading and lagging indicators. Rising churn may weaken future revenue, while higher data demand can support pricing, capacity investment, and long-term customer value. In your answer, talk about service revenue growth, ARPU, churn, subscriber additions, customer acquisition cost, EBITDA margin, CapEx intensity, cash conversion, network quality, NPS, and how operational indicators lead financial results. Question 4. How would you build a forecast for Telia's operating performance? I would build the forecast from operational drivers rather than applying a simple growth percentage. I would project subscribers, gross additions, churn, ARPU, usage, equipment revenue, and enterprise contracts by market. Then I would model personnel, network, content, energy, and acquisition costs, followed by CapEx and cash flow. I would incorporate seasonality, management guidance, and base, upside, and downside cases, updating assumptions when actual performance challenges the original forecast. Be sure to mention a driver-based model, historical trends, subscriber and ARPU assumptions, churn, seasonality, costs, CapEx, management guidance, scenario analysis, and regular validation against actual results. Question 5. How do you perform a budget versus actual variance analysis? I first quantify the variance and prioritize items that are material or strategically important. For revenue, I separate volume, price, mix, currency, and timing effects. For costs, I distinguish rate, headcount, usage, efficiency, and one-off items. I then validate the explanation with commercial and operational owners, check whether the issue is temporary or structural, and update the forecast or recommend actions rather than merely documenting the difference. Focus on identifying material variances, separating price, volume, mix, timing, currency, and one-off effects, validating data with business owners, explaining root causes, and translating findings into corrective actions. Question 6. Explain how the three financial statements are connected. Net income starts on the income statement and flows into retained earnings and operating cash flow. In the cash flow statement, non-cash items such as depreciation are added back, while working capital movements adjust cash. CapEx reduces cash and increases property, plant, and equipment, with depreciation later reducing earnings. Debt raises cash initially and increases liabilities, while repayments reduce cash and debt. The balance sheet must balance after every movement. Make sure to cover net income flowing into retained earnings and cash flow, depreciation affecting profit but not cash, working capital movements, CapEx, debt, and the balance sheet's role as the reconciliation point. Question 7. How would you assess Telia's cash flow generation? I would start with EBITDA and reconcile to operating cash flow through working capital, provisions, cash taxes, and other operating items. I would then subtract maintenance and growth CapEx, spectrum or license payments, restructuring costs, and interest where relevant to derive a meaningful free cash flow view. I would separate recurring cash generation from exceptional items and compare conversion across periods, because strong EBITDA does not automatically mean strong distributable cash. Discuss EBITDA to operating cash flow conversion, working capital, cash taxes, interest, CapEx, spectrum payments, restructuring, free cash flow, recurring versus exceptional items, and reconciliation to reported figures. Question 8. How would you evaluate a major network investment or 5G project? I would evaluate the project through incremental cash flows, not total company results. I would estimate additional subscribers, ARPU, data usage, enterprise contracts, avoided operating costs, maintenance expenses, and implementation CapEx. I would calculate NPV and IRR using an appropriate discount rate, then test adoption, pricing, timing, and cost assumptions. I would also consider coverage obligations, vendor dependence, execution risk, and whether the investment protects competitiveness even before producing direct revenue. In your answer, cover strategic rationale, incremental subscribers and revenue, capacity benefits, operating savings, CapEx timing, NPV, IRR, payback, sensitivities, execution risk, and regulatory considerations. Question 9. How do you calculate and interpret NPV? NPV equals the present value of expected future cash inflows and outflows, including the initial investment. I discount each period's cash flow using a rate reflecting the project's risk and capital costs, then sum those values. A positive NPV indicates value creation relative to that hurdle rate. I would not rely on the headline result alone. I would test discount rate, adoption, pricing, investment timing, terminal assumptions, and downside scenarios. While answering, explain discounted future cash flows, initial investment, discount rate, timing, terminal or residual value, value creation above zero, and sensitivity to assumptions such as WACC and growth. Question 10. How would you analyze a downside scenario for Telia? I would define a credible downside rather than simply reducing every assumption by the same percentage. For example, increased competition could lower ARPU and raise churn, while inflation could increase energy and network costs. I would model the effects on revenue, EBITDA, cash flow, leverage, covenant headroom, and investment capacity. I would then identify mitigations such as repricing, cost controls, procurement actions, or delayed discretionary CapEx, with explicit monitoring triggers. Be sure to mention realistic operating shocks, such as higher churn, price competition, inflation, energy costs, currency movements, delayed CapEx benefits, liquidity effects, management actions, and clear decision triggers. Question 11. What working capital issues are relevant to a telecom operator? Relevant items include customer receivables, handset and equipment inventory, supplier payables, accrued network costs, prepaid services, and contract-related balances. I would examine collection trends, billing timing, payment terms, inventory turns, and seasonality. A deterioration in receivables may signal weaker collections or aggressive sales, while excess handset inventory can tie up cash. I would reconcile movements to business activity and accounting classifications before concluding that operating performance changed. Focus on receivables, contract billing, handset inventory, supplier terms, prepaid balances, accrued costs, customer deposits, seasonality, cash conversion, and distinguishing operational changes from accounting reclassifications. Question 12. How would foreign exchange movements affect Telia's financial analysis? I would separate transaction exposure from translation exposure. Local subsidiaries may earn revenue and incur costs in different currencies, creating economic or transactional effects, while converting results into the reporting currency creates translation movements. I would analyze reported and constant currency growth, identify revenue-cost mismatches, review hedging policies, and quantify sensitivity to major currencies. This prevents currency movements from being mistaken for genuine changes in customer demand, pricing, or operating efficiency. Discuss transaction and translation exposure, local currency performance, reporting currency, revenue and cost mismatches, hedging, constant currency analysis, sensitivity, and separating operational performance from exchange rate effects. Question 13. How would you assess Telia's leverage and financing position? I would review gross and net debt, leverage relative to EBITDA, interest coverage, liquidity, debt maturities, covenants, and available committed facilities. I would include lease liabilities where relevant and assess whether operating cash flow comfortably funds interest, CapEx, dividends, and refinancing needs. I would also consider rating objectives and sensitivity to EBITDA decline or higher rates. A strong analysis connects reported leverage with actual flexibility under downside conditions. Mention net debt, EBITDA, interest coverage, maturity profile, liquidity, covenants, cash flow, lease liabilities, rating considerations, refinancing risk, and how CapEx and dividends influence financial flexibility. Question 14. What would you consider when assessing impairment risk for telecom assets? I would first identify impairment indicators, such as sustained underperformance, customer losses, regulatory changes, technology shifts, or a falling market valuation. Assets are typically assessed within cash-generating units, comparing recoverable amount with carrying value. I would challenge forecasts, discount rates, terminal growth, margins, and CapEx assumptions, then quantify headroom and sensitivities. The key judgment is whether weakness is temporary or indicates a permanent reduction in expected cash flows. In your answer, cover cash-generating units, triggering events, value in use, fair value less costs of disposal, forecast cash flows, discount rates, terminal growth, headroom, and transparent sensitivity analysis. Question 15. How does International Financial Reporting Standards 16 affect analysis of a telecom company? International Financial Reporting Standards 16 generally brings leases onto the balance sheet through right-of-use assets and lease liabilities. Instead of recognizing a single operating lease expense, the company records depreciation and interest, which usually increases reported EBITDA but also increases debt-like obligations. Cash payments remain important, even if their presentation changes between operating and financing activities. I would adjust leverage, fixed charge coverage, and peer comparisons consistently rather than focusing only on EBITDA. Cover lease capitalization, right-of-use assets, lease liabilities, depreciation, interest, EBITDA uplift, cash flow presentation, leverage effects, and the importance of consistent comparisons across companies. Question 16. How would you ensure the accuracy of a financial analysis? I use a structured control process. I reconcile source data to the general ledger or published reports, check opening balances and control totals, inspect formulas, and compare outputs with prior periods and operational metrics. I keep assumptions clearly documented, separate inputs from calculations, and use version control. Before presenting results, I perform an independent reasonableness review and ask the relevant business owner to confirm unusual movements, preserving an audit trail for key judgments. Make sure to mention source reconciliation, control totals, formula checks, version control, reasonableness tests, documented assumptions, independent review, audit trails, and escalation of unresolved data inconsistencies. Question 17. What makes an effective management financial dashboard? An effective dashboard answers management's decisions quickly. I would include a focused set of KPIs, trends, budget variances, forecasts, and traffic light indicators, segmented by market or product where useful. Each metric needs a clear definition, owner, frequency, and reliable source. I would highlight the drivers behind movements and the required actions, not overwhelm users with detail. A good dashboard also allows drill down from group results to operational causes. Focus on decision relevance, concise KPI selection, trend and variance visibility, clear definitions, segmentation, drill down capability, data timeliness, visual clarity, and highlighting actions rather than merely displaying information. Question 18. How would you prepare a business case for a new telecom product? I would begin with the customer problem, target segment, competitive offering, and realistic adoption curve. The model would include pricing, subscribers, usage, churn, cannibalization of existing products, customer acquisition costs, network capacity, support expenses, launch investment, and taxes. I would calculate contribution margin, break-even timing, NPV, and downside cases. After launch, I would compare actual cohorts and economics with the business case and revise investment decisions accordingly. Discuss target customers, market size, pricing, adoption, churn, cannibalization, variable and fixed costs, launch investment, regulatory needs, NPV, break-even, and post-launch performance measurement. Question 19. Tell me about a time you found an error in financial data. In a reporting exercise, I noticed that a cost increase did not align with headcount or supplier activity. I traced the variance to a duplicated monthly accrual caused by a spreadsheet import. I confirmed the issue against the source ledger, quantified the impact, informed my supervisor promptly, and corrected the report. I then added a duplicate check and reconciliation step to the process, turning an individual error into a stronger recurring control. Be sure to mention the discovery method, materiality assessment, evidence, communication, correction, root cause analysis, control improvement, and maintaining professionalism without blaming colleagues. Question 20. Telia's revenue is below budget, but EBITDA is above budget. How would you investigate? I would first decompose the revenue shortfall by market, product, volume, price, mix, churn, and currency. Then I would bridge EBITDA, checking whether lower variable costs, delayed hiring, procurement savings, cost timing, or one-off credits offset the miss. I would investigate capitalization or classification changes and confirm cash flow implications. Finally, I would assess sustainability. Temporary cost timing may reverse, whereas genuine efficiency can support future margins despite weaker near-term revenue. In your answer, cover revenue mix, cost timing, pricing, churn, one-offs, capitalization, foreign exchange, variable versus fixed costs, sustainability, cash flow, and questions for commercial and operational stakeholders. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.